have tuned into Midcap Masala right here on ET Now, and let's put the spotlight on Tata Consumers. And we spoke with Sunil D'Souza, the Managing Director and CEO of Tata Consumer Products. The stock is definitely up 4% after a strong show in Q4. And here's Snehi in conversation with MD and CEO Sunil D'Souza.
We've had a good quarter by all metrics, right? We've had 18% top line, 27% EBITDA, and a 22% group net profit. We've delivered growth across all our businesses. So while India business was -1, volume grew 4 as we gave back pricing to consumers. Was 12, Sampann was +69, Ready was +23. Capital Foods was flat because of the Middle Eastern and issues. Organic India grew 24. International to the party. International overall, US grew 30, UK grew 17, Canada grew 19. Even for the full year, they've delivered good numbers. On the financial front, also, our ROC improved 110. We delivered 107% of free cash to EBITDA. And our working capital, we down to 21 versus 26. In fact, working capital today is less than 6 years when we started off in absolute terms while we've grown the business. In terms of our channel strategy, everything came to play. Trade is now growing 20% at 15% of our portfolio. Quick com and e-com have now moved from 15% of our portfolio to 21, grown 60%.
Okay, so Mr. D'Souza, that sounds really good. And you've also reiterated double-digit revenue growth with EBITDA growing ahead of revenue. Can you help us understand what are going to be some of the biggest levers when it comes to margin expansion and EBITDA growth in FY27?
So broadly, nothing changes from the guidance that we've given in the past. Our base businesses of international, tea and salt, mid to high single-digit top-line growth. Our growth businesses, last quarter, our growth businesses accounted for 33% of our portfolio growing at 33%. They are going from strength to strength. We've relayed our go-to-market to give special focus to either salt in strong geographies or growth businesses in geographies which need it. And our innovation to sales will continue. We'll continue to expand our portfolio, enter new categories, build our new channels. So that's the key to driving double-digit growth. We're extremely conscious that we need to bring it up over a period of time. And that's why the focus will be to grow EBITDA ahead of top line.
Okay. And Mr. D'Souza, within your commodity basket, while we understand that tea and coffee prices are favorable for you at the moment, on the other side, you have crude and packaging costs that are surging. On the back of these prices in your mix, how should we look at pricing action that the company plans to undertake going ahead?
See, the result of this entire Middle East crisis, number one was supply continuity, which I think we've tackled by finding alternate suppliers, mostly based in India. So that's not an issue. Fuel continuity for production. We moved a lot of our production from LPG to alternate LPG sources and or to dual burners. So from that perspective, there's no issue. Fuel prices, your guess is good as mine as to where they will go. There has been a creep on packaging costs, especially as things have moved. We remain confident of our brand strengths, our strengths across different parts of the portfolio. Therefore, if we see pressure on margins, we will look at calibrated price increases. And therefore, we remain quite confident of delivering margin expansion as we go forward.
So that sounds good. Mr. D'Souza, if I talk about the tea margins, they normalize because costs soften, but you also passed on that deflation to the end user. Going ahead, how should we look at the mix between tea volumes and also protecting margins for the tea business?
See, broadly, we will continue to gain share from the unorganized to the organized, right? We are the number one now on e-commerce. And e-commerce, like I said, e-com and quick com account for 20% of our portfolio. Modern trade is 15% of our portfolio. So our brands are going from strength to strength. We've gained on either top of mind or spontaneous, whichever way you calculate brand strength. On tea, broadly, we operate on a 33 to 35 gross margin. And my gross is almost equal to contribution. We operate on that lever because if we go ahead of that, then we let the unorganized creep in. If you go below that, then we're leaving margin on the table. So over the years, we've learned 30 to 35 is the right number, and we'll keep calibrating for that. And therefore, we remain confident of mid to high single-digit top-line growth.
Okay, and so while that sounds good, Mr. D'Souza, also talk about the India Foods business that has now overtaken your beverage business to become the largest contributor to the overall pie. How should we be looking at the business mix going ahead?
So let me say this entire foods business becoming larger than beverages is by design and not by default. When we had started 6 years back, we had charted the entire food and beverage space and decided where to play. First, we have in foods, we have this very, very strong business of Tata Salt. That's gone from strength to strength. I think this is the third quarter of double-digit volume growth that we've delivered and double-digit top-line growth on what is already a 90 penetration category, and we've got close to a 40 share. So there we're going from strength to strength. Apart from that, our entire foods portfolio, rest of the foods portfolio is part of our growth focus, whether it is Sampann, whether it is Capital Foods, Organic India, Soulful. That, like I said, last quarter now contributes for 33% of India business growing at 33. And by the way, we're continuing to improve margins on all of them. Sampann, which was close to zero, -5 to 0 margin when we started 6 years back, is now entering mid-teens in terms of margin. So foods will continue to be focused. We will continue to expand the portfolio. We'll continue to drive innovation, and we'll continue to drive availability and distribution.
Okay, understood. And let's also talk about Tata Sampann and the pace at which it is growing. By when can we expect to see mid-teen margins for Tata Sampann, and what's the growth outlook in general for this segment?
So on the margin front, it's already at the low teens, and we'll continue to innovate as we build scale in the categories that we play in, and therefore negotiating strength, if I may call it. And as we enter new categories which are positive to the business in terms of margin itself, they're accretive. So Sampann, like I said, we had charted out categories where we want to play, and we're slowly expanding our portfolio into those categories and innovating as well. The two big hits last year have been dry fruits, which is now close to a 400 crore run rate, and cold pressed oils, which is close to a 300 crore run rate. But the base premise of Sampann is to enter categories which are trust deficit, have good margins. The Tata brand name brings trust, credibility there. We have the ability to differentiate and distribute that product. So Sampann will continue on a high growth trajectory. Yeah, for the full year, we've delivered a 49% top line. For the quarter, it was a 69% top line. But overall, we're saying 30 plus is a good number to peg it at.
Okay, so we'll be watching out for that 30 plus number over there. Mr. D'Souza, let's talk about the salt segment now. Yet another good show, a good quarter coming in for salt. Talk to us about, in terms of what lies ahead, are you seeing more premiumization or category expansion opportunities within the salt basket?
So salt, first of all, you've got to understand that have just about 55% share. Right? 45% of the category in India, and the category is 99% penetration. So 99% of households in India do use salt. And out of the 55 share, we have 40. So we're 6 times larger than the next biggest. So it's up to us to continue to grow the branded category. There's opportunity both at the higher end as people premiumize, as well as converting I call it the no-name brands to Tata Salt, so to speak. So we're focused. At the bottom end, we've got I Shakti and Shuddh, which we're driving in specific geographies. At the higher end, we've created a bouquet of products giving consumers what they want. So we've got salt, light, super light. We've got salt with zinc for immunity or iron for fortification. We've got rock salt, pure Himalayan rock salt, or we've got Senda Namak. So we've got the entire range. And what we are finding is consumers would like to use more than one salt, sometimes for occasion, sometimes for dishes. So as the most trusted brand in the country, Desh Ka Namak gives them more options. The consumers reach out and pick it up.
Okay, that's good to hear. And lastly, Mr. D'Souza, this is the third consecutive quarter of positive same-store sales growth for Starbucks. As I understand, you've opened a new reserve in Kolkata too. Talk to us about what's the growth plan for Starbucks, any particular store count number that you're targeting, and in general, what is the trajectory that you're aiming for when it comes to the SSSG for Starbucks?
So Starbucks, we've always maintained coffee secularly is a growth opportunity in India, both in-home and out-of-home. In-home, we play with Tata Coffee. Out-of-home, we play with Starbucks. The whole QSR segment was going through a rough patch till about Q1 of this year. But after Q1, sales have started to pick up. And yeah, you're right. This is the third successive same-store sales growth. We got a 5% same-store sales. We are now the largest chain in the country, 80 cities, 502 stores. So we'll continue to open stores. We had calibrated that store opening a bit to ensure that we fix different levers in the business while accelerating. Starbucks is on footing, high teen, EBITDA margins, EBIT for the last hit it out of the park again. So you could see aggressive expansion. Reserves are not a mass phenomenon. It is more to build image for the Starbucks brand. We've got one in Mumbai, we've got one in Gurgaon, and now we've opened one in Kolkata. So you'll see flagship stores opening in key metro cities.